Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're breaking down the number one risk to your retirement right now. Now, if you're planning on retiring in the next 12 months, this is a video that you cannot afford to miss because this risk can drain your retirement faster than you can imagine.
Yeah.
And please make sure to watch to the end because we're also going to be breaking down some specific strategies to minimize this risk. So, Brian, let's get right to it. What's the number one risk you see?
There are a few, but if I could pick just one that would have the greatest impact on someone nearing retirement, I would say it's the sequence of returns risk.
Okay.
And this risk refers to the potential negative impact that the order or the sequence of investment returns can have on your portfolio's value over time, especially during the distribution phase of retirement years. You will see this risk with investments that are volatile, like with stocks and index and mutual funds. And the risk is especially concerning for those who are withdrawing funds from their investment portfolios to support their retirement income.
So, would you walk us through what this might look like? Give
Sure
us a
thing.
real world scenario.
Sure. Let's say you're retired and you're generating income from your current investments.
Okay.
If you experience a significant market downturn early in your retirement years, this can have a detrimental effect to your portfolio. And here's why. You may need to sell investments at these lower prices to generate income, and this means you're going to have to lock in losses. The combination of market losses and ongoing withdrawals may strain your portfolio and deplete your retirement savings faster than you planned. Whenever this happens in retirement, it's not good. But if a significant market decline occurs early on in retirement, this can impact long-term growth and the income potential because your portfolio will have less time to recover and benefit from future market upturns.
Got it.
And it can draw your retirement savings down twice as fast.
Yeah.
Let me show you what I mean. This chart is from Schwab's Center for Financial Research. It's hypothetical and for illustrative purposes only, and it does not reflect expenses, fees, or even taxes. Okay. Both investors had a starting balance of $1 million, took an initial withdrawal of $50,000, and they increased their withdrawals 2% annually to account for inflation. Investor number one's portfolio assumes a negative 15% return for the first 2 years and then a 6% positive return for the years 3 through 18. Investor number two's portfolio assumes a 6% return for the first 9 years, a negative 15% for years 10 and 11, and then a 6% return for years 12 through 18.
So, taking a negative hit to your portfolio in those first few years of retirement really can destroy someone's retirement savings.
Yes, it can. And this is exactly how the sequence of returns risk works against you.
Got it. Wow. All right. So, let's move on to some strategies that may help lessen risk.
Yeah, I got 3 solid strategies I want to go over. The first one is diversification. If you can maintain a well-diversified investment portfolio against different asset classes, this can help reduce the impact of poor performance in one specific investment or one sector.
So, if one sector fails, another may rise to offset those losses.
Exactly. Number 2 is to build up an emergency fund or hold a cash reserve. If you got liquid cash sitting on the sidelines, this can provide a buffer during periods of market volatility.
Yeah, this is something you're always talking about on this channel. Build that
Always.
emergency savings. And in this scenario, because you have cash to draw from, you can hold off selling those investments at a better time when the market's rising.
Exactly. That's the point of it.
So, how much liquid cash do you suggest people have on hand at any given time?
I would say 6 to 9 months of all your expenses should be liquid.
Yeah.
And in today's higher interest rate environment, you can still make good interest on this emergency cash.
Yes, you can. All right. What's the third strategy to lessen the risk?
Longevity planning.
Hmm.
You need to plan for life expectancy, healthcare costs, and potential long-term care needs ahead of time.
Okay.
So if you plan on retiring within the next 12 months, I encourage you to sit down and make sure you budget for these items and make sure that budget is accurate. Get exact numbers, not just estimates.
Sure.
This can help make sure your assets are positioned to support these costly retirement expenses over your retirement lifetime.
If you want to know the true cost of retirement, we break down actual expenses in a video we did, and we're going to drop that link below in the description and the pinned comment. Go check that out because like Brian said, you need actual numbers, not just estimates. This is critical,
Definitely.
especially when you're dealing with healthcare, which is just insane alone.
Yes.
So go check that out. Also, make sure to hit that like button if you like the content of this video, and don't forget to subscribe. So Brian, before we wrap this up, any parting words of wisdom?
I would say that this video that we just did here is so important that I want you to go back up to the top again and start watching this one more time and get this straight.
Got it. Yeah. Understand the sequence of return to risk for sure. All right. On that note, hit that like button, help us grow this channel, and don't forget to subscribe. And Brian, as always, thanks so much for this. And thanks to everyone who watched.
Thanks, everyone. Have a great day.